Good to have everyone here on this wonderful afternoon as we digest all the news of the week, and we had a lot of it, mainly the Federal Reserve. Rob, good to see you.
Great to see you, Trish.
You know, we talked ahead of this and on air, live like this, and we were both like, okay, like if they do 50 would be really, really aggressive. Elizabeth Warren wanted 75, but she's off, on her own island there. I think most people were sort of the belief that, maybe 50, might be the outlier. Like maybe you could get it, but for sure 25 with the promise of more to come. They came forward with 50 basis points, which means, as Donald Trump perhaps rightly said, either we got a real problem going on in the economy that shows you how weak the economy is, or it's a political thing. Let's leave the politics aside for just a moment and think about where the economy is right now. Inflation has come down, but jobs being added, those are kind of lousy. I mean, really, really bad showing. They keep messing up the numbers. They keep missing the numbers. They thought they had a whole lot more than they had, and we saw that reflected in recent jobs reports that they're just not adding what they need to add in order to keep pace and to have growth. Was 50 really necessary at this point? I guess we'll know in time, right?
Yeah, I guess the market was thinking, it could be 25 or 50, and the market really didn't know. They went with the larger cut, and it does raise questions. What exactly are they seeing? How how healthy is this economy? We had those jobs revisions and the weak, disappointing numbers in recent weeks. Mm-hmm. It's interesting also just in the context of, back in July, this last Fed FOMC meeting was less than 2 months ago. Mm-hmm. So, back then they kept rates flat. They didn't signal anything. Mm-hmm. Things looked stable. And since then you had this really weak jobs data and the revisions, and I think other indications of softness in the economy. So it's a bit alarming. And I think a number of people are alarmed in that you've only seen 50 basis point rate cuts in the context of pretty severe.
I'm thinking about it, right? We're going back like some 16 years. I mean, you were dealing with the stress of 2008, I think, or yep. Shortly thereafter, right? I mean, that was kind of the big problem at the time.
I think basically there were three phases in the last 25 years. So during COVID, they moved 50, mm-hmm. Clearly in response to a potential collapse in the economy. So that was in the 2020 timeframe. And then when the financial crisis set in back in the 2008 timeframe, they moved 50. And then back after the dot-com burst, that was the prior.
So, in other words, there's not a ton of precedent for the 50. And yet they came forward with the 50 at a time when, Kamala Harris says the economy's doing just great. That's a bunch of what. But look, we've seen the numbers. We look at the numbers. I would just say, I'm not so stressed out to the point where I'd be doing 50. But then again, I would never have been leaving rates probably as high as they did for as long as they did, or have been cutting them for as long as they did, coming out of COVID. So this is a case, again, of them sort of not really getting the timing quite right. But we'd rather, I guess, that they'd be more aggressive in this case, given that inflation is down around 2.9% at this moment. Maybe they have a little more wiggle room.
Yeah, and I guess they're always fighting the last war. So you think back, before in was it 2021, mm-hmm. we had CPI ended up 7% at year end, and rates were still zero. Yeah. Literally Fed funds was zero, right? And they didn't start hiking. They did a tepid 25 bips rate hike right. in March 22. Mm-hmm. And so they were very slow in getting in front of the inflation situation, and now that probably influenced them in terms of doing a bolder move here.
Okay, so let's talk about what it means for markets right now. I'm just let me look at originally as this news came out, the market just soared, right? Everybody was super, super ecstatic, and then on Wednesday things actually settled a little lower because the euphoria wore off, and now people are just sort of ho-hum, I think, trying to get back to doing business. And I just wonder how much is priced in already how much upside there is as a result of these rates. I mean, you're going to try and balance it, of course, with the idea that, the economy may really actually be in a very bad spot.
Yeah, so the immediate reaction was positive. It was a positive surprise, but then the market. This was back on Wednesday, and then the market faded a little bit. But then the next day, everyone got excited again, and we had an up 2% day in the S&P. And today we backed off that a bit. Look, rate cuts are positive for asset prices across the board, right? They're positive for stock valuations. Gold has responded positively.
Yeah, I'm just looking at gold today, up 1.25%, $2,647 an ounce right now on gold.
Yeah, and the thing people should recognize with gold is that it's kind of competing with interest rates. When interest rates are high, investors preference for putting their money in the bank, earning interest. Interest rates are high. As they come down, there's less of that opportunity cost. So gold really benefits from lower rates. As do stocks. Because we have a lower cost of capital and it's cheaper for companies to borrow.
I'm actually, I just put the gold NYMEX up price per ounce right now, just so people could see that there. NYMEX near term versus its peers. Walk us through this chart. It goes back to, it looks like 22.
Yeah, that's a 2-year chart on gold, and you can see the most recent leg up very very recently, just with the rate cut. But a lot of this has been anticipated. So really over the past month, gold has performed quite well, really because people were anticipating, and the market generally was anticipating rate cuts, especially with those jobs numbers coming in light and the revisions. But over the past 2 years, the story of gold has really been basically an upward trajectory. A lot of different recently, the interest rate outlook.
Yeah, no, it's a lot of different things, and we've talked about this. I encourage people to explore the channel here at 76 Research. Also, make sure you subscribe, share, like, comment, all that good stuff. We are live right now on YouTube, but we do have some content that deals specifically with gold, because there's a lot of reasons, and we won't get into all of it at this particular moment, but I do encourage people to explore, because whether you're thinking about what's going on around the world and you have all these sovereigns, other countries basically saying, ooh, maybe I don't want to be so reliant on the US dollar. And so one of their diversification tools is to get out of treasuries, get out of dollars, and to go into gold. And so that's part of the reason for the upside. You also have just the reality, unfortunately, of this never-ending debt crisis that we are in right now. And I think that all of that sort of catches up with things. And, we've written on this quite extensively. I'm just putting the website up there, 76research.com. You can go there. You can get our newsletter. You can use code word dollar for the newsletter when you go to checkout, so that you get it for $1 a month for the first 2 months, $9.95 thereafter. But again, there's a wealth of information there in the archive. On the YouTube channel, of course, for free. You get free stuff if you go and sign up there on the website as well. But the key is to get the 76 report and to get, hopefully, some of the portfolios. We'll get into that in just a moment. But gold is one of those things that, yes, is seeing this upside right now. I would anticipate, look, Rob, you know this about me, right? Like I joke that I really, I'll feel nervous before I need to feel nervous sometimes. I don't feel that. I mean, other than maybe Kamala Harris winning and taxes going through the roof. I don't feel that nervous about the general economic climate in the sort of here and now, in part because I'm so convinced of the technology play. And so when I think back to other times when we've had struggles, and I think about the mortgage crisis that led us into 2008, the subprime debt crisis. I mean, I was going on about that in 2005, right? I was panicking about that long before I needed to be that worried about it. I was really worried about the dot-com bubble back in 98. And sure enough, it hit in 2000. So right now I'm looking and I'm like, okay, the Fed's worried. Normally I'm the one that's worried. So I hope it's not a political move. I don't want to dare say that that's in fact what is motivating things. I think if they wanted to make it a political move, they should have done it earlier. It's a little late at this point. given that these things take time to work their way through the economy, but the thinking, and just as a primer, and walk us through it, is that people will have more access to capital. Theoretically, businesses should have more access to capital because rates are coming down. Therefore, you can borrow more cheaply, and thus more people are expected to borrow, thereby driving this engine of growth, which is, based on borrowing. Whether we like it or not.
And that's how, the logic works in terms of interest rate manipulations to kind of spur the economy or slow it down. I think, what really has been happening and the way that perhaps Powell framed it is the point of getting interest rates, the Fed funds rate, to such high levels has been to kind of to suffocate the economy. We've had this inflationary burst, as he put it, which I thought was kind of an interesting description. We went from transitory to burst, which I guess lasted longer, a couple of years. And now they're getting evidence that it's really damaging the consumer, and we see
you think?
It's not just the jobs, but it's credit card delinquencies, and there's other indications that the consumer is really suffering. So I see it as kind of like a bit of a divide between like new economy, old economy, like we talked about 25 years ago, during the tech bubble. Regular people, everyday people, traditional industries, people are suffering under the weight of high prices and high interest rates. But separately, when you look at the tech economy, I don't see any weakness there, and I don't think the Fed's signaling at all any weakness there. This is more about the broad consumer economy suffering under the weight of a very high interest rate environment. And to be fair, rates have been quite high, and they have a lot of wood to chop. If we are getting to the point where the economy is potentially in a perilous situation, you're coming from 5.25, and what people tend to think of a neutral rate is 2.5 to 3. So
yeah. No, I hear you. Okay, so look, they're moving. They're really moving more than they maybe should, but we'll go with it. Here's Powell. I want you to hear him. I mean, is it me or is he complimenting himself here? Jay Powell talking about how brilliant he's been at this management of inflation. I wonder if the regular American consumer would tell you that, Jay. Anyway, here he is.
Our restrictive monetary policy has helped restore the balance between aggregate supply and demand, easing inflationary pressures and ensuring that inflation expectations remain well anchored. Our patient approach over the past year has paid dividends. Inflation is now much closer to our objective, and we have gained greater confidence that inflation is moving sustainably toward 2%. As inflation has declined and the labor market has cooled, the upside risks to inflation have diminished and the downside risks to employment have increased. We now see the risks to achieving our employment and inflation goals as roughly in balance, and we are attentive to the risks to both sides of our dual mandate. In light of the progress on inflation and the balance of risks, at today's meeting, the committee decided to lower the target range for the federal funds rate by 0.5 percentage point to 4.75% to 5%. This recalibration of our policy stance will help maintain the strength of the economy and the labor market, and will continue to enable further progress on inflation as we begin the process of moving toward a more neutral stance. We are not on any preset course. We will continue to make our decisions meeting by meeting.
Yeah, interesting about this one, though, is that, overwhelmingly everybody was in agreement. Sometimes you might see a little bit more, of a debate going on, but it seemed like most of them were like pretty positive that they wanted to move forward on the 50 basis points.
In terms of the reporters or the Fed governors?
No, the Fed governors, forgive me.
Yeah. You did have that one.
There was some consensus there. Yeah, just one though. I mean, that kind of surprised me. Hey, so Peace of Mind has a point of view, saying I supposedly get richer by borrowing more money at a lower rate. That doesn't make sense to me. Yeah, you know what? Peace of my mind. I'm just gonna say this. No, you don't want to be like borrowing more. It's an astute observation, right? I think the point though is that companies will perhaps invest more or build new factories, take more risk because money is cheaper. On the individual level, I'm still kind of old fashioned, like, you pay off your mortgage and stuff like that, right? Like you don't need to get too sophisticated with the financial engineering. But in terms of what really makes Wall Street go, yeah, lower rates. I mean, look, Trump loves them. Trump loves low rates. That's his whole thing. We want low inflation and low rates. That's kind of, a hard thing to accomplish because typically if you're having really low rates, you run the risk of having, especially if the economy is like in really buoyant shape, you run the risk of having thus inflation, which is what we've seen for the last 3.5 years. Honestly, if Kamala and Biden knew what they were doing, they would have pulled Janet Yellen aside, Jerome Powell aside and said, guys, you know what? I realize you're trying to do us a few favors. Don't. We just want the economy to work without the inflation.
You know what's interesting? Just now that peace of mind though is kind of bringing up this question of like how interest rates really feed into the economy and how it all works. Powell did in the conference call bring up the issue of housing, which I think is kind of a pretty to.
I lost you for a second. You think it's pretty what?
No, it's an interesting dimension to this because he was saying it's actually unclear whether higher interest rates or lower interest rates, like what the impact is on house prices. Because as interest rates went up so much and mortgages got so expensive, what was happening is people were sort of locked into their homes. They were unwilling sellers. And that was like kind of freezing up the market and potentially causing prices to go up. But now as we cut rates, does that mean that, because traditionally you think about it, okay, cheaper
right,
mortgage.
Because you can afford more home, right?
Yeah.
Interest rates are lower. You're sitting there with the back of the envelope calculation. Oh, well, then my mortgage payment's only, because people are thinking, what am I paying this month? As opposed to what am I paying over the life of the loan, et cetera. And so consequently, you tend to see a rise in home prices when you have cheap money available. But,
right, which goes,
that would not be ideal given how high home prices are right now.
Yeah, and it goes against the premise here that so we're back to home prices driving inflation forward. As we lower rates and mortgages get cheaper, we're back to the housing piece puzzle pressing prices up. But we'll have to see. So
it's worth watching. It's worth watching. I mean, I wonder if this time it could be different, so to speak, right? Like, could it really? I mean, look, the best case scenario is that Powell is a genius and you know what? Like, he was somehow able to engineer a soft landing. This is sort of what he's saying. I think it was a big pat on his back. I did it. We did it. We had a burst of inflation, whatever, as you said, the new word for transitory. And now we're moving forward and we're going to lower rates and kind of free things up again. It feels like a little bit of whipsaw, but here's what I would say about the markets. Like, as long as you're not actually heading into a full-on recession, and I don't think so. I mean, there have been moments when, again, I'm looking at the data and I was looking at really high CPI, consumer price indexes, and PPI numbers coming out of 21. And I just thought, or in 21, I just thought, there's a real chance of recession here, a real chance. And we weren't growing enough in my estimation. I don't get that sense right now. I mean, I understand things are slowing, but not in the same kind of dire way that they felt like they were slowing along with rising inflation before.
Yeah, I mean, as I kind of look at companies and listen to their earnings reports, I think it's a mixed bag. I mean, there are certain sectors where the economy's under more pressure.
Yeah.
I think from an investment standpoint, you really want to just look closely at like your underlying like exposure, and it's different, right? Like certain companies will have more sensitivity to like a potential like softness in the economy than others. So it's a good moment to be in those companies that really don't have quite that vulnerability.
Yeah, I mean, I should point this out. This data is ending last month, but if you look at, for example, our basic income portfolio, the income builder portfolio, I'm just going to show people here again with the caveat that this data is dated from the quarter ending at the August 29th. But, all of these I think are actually still seeing some upside. You get a median stock return there, a value of 15% versus the S&P at 6%. So a little bit of a credit to us. I mean, I do think that you've got to pick the appropriate companies in a time like this, especially in a time like this. You know what? Like in good times, Rob, anyone can do it. That's the truth of it, right? I mean, in when the market's just going up and away, all you have to do is buy Nvidia, right? Or at least, as you did, have the foresight to, and I wrote about it actually right before it started to take off, with the idea that this whole Web3 and the metaverse is quite real and is going to be massive in ways that we can't even fully comprehend at this moment in time. And I still believe that. So I still really, really like the tech space. But you've got to be, I think, even more thoughtful when you get into this dicey sort of environment, which is, why I like things like our basic income portfolio, why I like things like, even our growth portfolio, which actually doesn't include Nvidia, and maybe just explain to people why we didn't do that.
Nvidia, I think, I felt people a tremendous service by including Nvidia in the list. It's a pretty impressive company. You can have the because the PE multiple is not terribly high given the growth, but the margins, there's questions around the sustainability of the profit margins. And I think most people, taking with index exposure have, the S&P is 6% Nvidia. So you have plenty of Nvidia exposure. Perhaps it's more interesting to identify, if you're going to do individual stock picking, find some other opportunities that you wouldn't have as much exposure to via your more passive investments.
Mm-hmm. So the resilience portfolio really focusing on that growth, sort of ex Nvidia as you would for reasons which you've outlined. And then we have an inflation protection portfolio. We do like gold. I'll be very forthcoming about that. On my own show, I actually work with a gold company, and we do push. Look, I invest in gold myself. I see that as a diversification tool. And then when we built out this portfolio, you also, I think we were in agreement in that it was just one of those things. It's a very sort of dicey thing. A lot of financial advisors will be like, oh no, never, don't buy gold. It's not real. It's not an asset. And I'm like, well, you know what? Like, it tends to typically track pretty well, with inflation. And so if I want to preserve my dollars in some way, given that gold's priced in dollars, it's one of those opportune spots.
Yeah, I agree. And we have several gold-related investments within the inflation protection portfolio, basically like streaming companies. So I think, from a long-term standpoint, if you want to protect your savings from inflation and from the erosion of monetary debasement, gold has been and will continue to be an important asset class.
Mm-hmm. Let me turn over to, and we've certainly done a lot on Bitcoin too. We've been talking about tech here. There's a potential deal. I want to cite actually the Wall Street Journal here. Qualcomm approached Intel about a takeover in recent days. Wow. Okay. So, we talk about the semi space, and Qualcomm apparently has approached, and I'm sourcing the journal here, Intel, its rival in recent days, according to people familiar with the matter, and what would be the largest and most consequential deal in recent years. You're talking about a total deal value of possibly $90 billion. It would be coming as Intel has suffered a bit, especially vis-a-vis the Nvidias of the world. A deal, it says, is far, far from certain. Even if Intel is receptive, quote, a deal that size is all but certain to attract antitrust scrutiny for sure, though it is also possible it could be seen as an opportunity to strengthen the U.S.'s competitive edge in chips, which, heck, we need. Let me see if I can put Intel up here. Let's just take a look at the chart. What's your reaction to this? Do you like the idea?
Yeah. So this is definitely breaking news, just an hour ago or so. And it's, nothing firm, but it does sound like Qualcomm a few weeks ago was talking to Intel about buying certain pieces of the business. And now they're looking to potentially buy the whole thing. I think we need to kind of take a step back and really consider how much of a train wreck Intel has been.
Okay, so we can see it here in the chart.
Yeah, this is just this year.
Well, I mean, I guess this is versus Nvidia. So.
Well, no, but it's down more than 50% year to date.
Oh my gosh, yes.
Okay, and while Nvidia's up almost 250%, and it's important that there's one is kind of causing the other, by the way. But just to take a step back on Intel, you've made no money in Intel over the last 10 years. You've made no money in Intel over the last 20 years. Okay, Intel did pretty well, like I think going up, up into sort of until 2021 in that sort of time frame.
Mm-hmm.
And then it's been down 70%. So Intel is a disaster. And, we talk about it being like $100 billion deal. This is Intel. Nvidia's market cap is like $3 trillion. Okay, so this is really a sign of the times that,
why have they missed this opportunity so badly? I mean, have you spent any time on that? Was it just that?
Yeah.
Nvidia was more nimble initially, just kind of had the foresight to see what was coming. I mean, I'm laughing because one of our viewers here, James Bond James, saying, is Intel DEI now? I mean, look, the government was getting in there, right? They were going to build the big factory, weren't they? Like there was an idea we're going to onshore some of the stuff that's been overseas, and we're going to build a big factory. I think it was in Michigan for Intel. There's been a lot of hopes.
Benefiting from the CHIPS Act, but here's my initial read on what's going on here. When on the last earnings call for Nvidia, when Jensen Huang was there, a big AI bubble, data center bubble, AI chip bubble, his answer was basically, "What's going on here is we're redeveloping or rebuilding the entire computing infrastructure of the world, and it's going from a CPU model to a GPU model." And the reason people are doing it's not just AI, the computing that.
Okay, and just to back up for the layperson, like a computer processing unit, right, as opposed to like graphics processing unit. Is that what you mean, like CPU? And just walk us through.
Yeah, CPU. So basically, if you think about all the companies and all the people, everyone has, before Nvidia came out, with its GPUs, and before we started talking about all these data center activity, like in the last few years. Most of the infrastructure for information technology takes place via CPUs. So on the computers that we're using, or in like servers and within offices, and all of that's migrating to the cloud, and it's migrating to data centers. And the engine for that is GPU. So Nvidia's chips, no longer Intel's chips. So Nvidia's redeveloping or reinventing the compute, the information technology infrastructure at the expense of Intel and to some extent AMD.
Okay.
So that's why Intel's dying, and that's why Nvidia is thriving. So it's sort of
Qualcomm fix it potentially. Maybe it's better than the alternative.
Something should be done, and I think it does get. You mentioned at the outset, there'd be antitrust concerns. I would hope that somehow those get set aside, because the United States should protect Intel. We're very reliant.
Wow. Okay. You're saying it to an interesting crowd here, because this is not like typically, I don't know all our viewers, but not typically a crowd. And I know you're not the kind of guy that normally wants to protect any industry per se, but I think you're talking about national security concerns here.
I am, yeah. TSM in Taiwan, makes 90% of all of the advanced chips. Okay, mm-hmm. So we need to have the ability to make chips, advanced chips, in the United States and domestically, in our borders. Mm-hmm. And if we start getting look, the CPU chip market, Intel versus AMD, that's all commoditized. They're not making any money. That's the problem. That's why the stock's down so much.
They've laid thousands of people off. I think those notices came, late summer. They were just, making thousands of layoffs. You said they're not making any money. And it's sort of this business that feels sort of dead in the water compared to what's really going on, say, over there, Nvidia.
Yeah. And, look, if the future is AI and the future is GPUs and they're all being made in Taiwan, That to me, that's not an ideal scenario. That puts us in a vulnerable position. So I think something needs to be done at Intel to, you know,
I
make
mean,
this
this should be good for
transition.
the stock. I mean, just, I guess it's a bit of a bet on whether or not you actually see the acquisition go through. Also, it's not clear to me. Well, it's 90 billion. I don't know what that is per share. I'd have to run the math. But as recently as 2020, the company had a market value above 290 billion. Oh my gosh.
Yeah, now it's below
So, I mean,
100,
it's
right?
down like 60% this year. But like, if you think about going from 290 in 2020 to now, possibly being 90 billion, I mean, people just aren't too psyched.
No, it's sad. It's dreadful. And Intel's an important company, and I'd be curious to see like what maybe Qualcomm can, maybe this deal, if it happens, can facilitate the resurgence of Intel or kind of the reinvention of it and position it to be more competitive, within where the chip industry is going, which is in the direction of GPUs.
Viewers agreeing with you there, both on Facebook and on YouTube right now that, we got to actually be thinking pretty strategically about how we protect an industry that is so critical to the future. I mean, look, there's a lot that's sort of hanging in the balance right now in terms of our future, in terms of tech's future. And this is something we want to own. I mean, in terms of the future of money too, we've talked about this at length, looking at things like Bitcoin and Ethereum and how do we make sure that the U.S., we're the hegemonic power in the world for a reason, right? And if you want to be strategic about that, maybe you're not like running off and fighting every war, but you are being thoughtful about technology and the role of money and the role of security in the future.
Yeah, and I think the way cryptocurrency or Bitcoin potentially plays into that is rather than look at it as an enemy or a competitor, because it's going to survive and it's going to be a form of money that's utilized worldwide. Why not make it kind of bring it into the American umbrella and almost make it an accepted or secondary form of U.S. currency in a very vague sense?
It's happening very fast, right? Because look, BlackRock is now involved, and you think about the different various ETFs. It's not just BlackRock. I mean, there's a variety of options now for people that want to invest in Bitcoin, but maybe not have the cold wallet, so to speak. So you can do this via an ETF. And I think that's actually, to me anyway, I know a lot of like diehards are like, no, we want to keep it protected. And I'm like, I kind of like that there's some structure around it, at least from my own investing standpoint, because hopefully, it's not going to just go poof away or get stolen or something like that if there's some structure around it. So I'm not that much of a diehard. I mean, I like gold, but I also like Bitcoin, and I like a little bit of structure around it too.
Yeah, well, look, but actually, it's interesting just on the gold point because if you're a gold investor, you don't want gold. The worst case scenario is that we have a replay of what happened in the early 20th century when gold was confiscated. Yeah. So you don't want your asset to become viewed as unacceptable to the authorities, right, or to the government. You want it to be accepted and supported by the political environment. But at the same time, but gold, even though gold is legal and we can buy and sell gold and buy gold ETFs and all of these things, you want, if you're a Bitcoin investor, you want to be in that exact same position where it's not a problem. It's not viewed as a problem for the government.
Yeah, and I think increasingly we've gotten away from that. I mean, again, some of it may depend on who comes into office next, and not just the Oval Office. I mean, we'll look at the Senate, we'll look at Congress overall, right, the House of Representatives, to see where they shake out on this stuff. It seems to be right now in this particular landscape, and we've talked about this. I encourage people to go and look at what we said the other day about, for example, Michael Saylor's big bet on Bitcoin and Vivek Ramaswamy being there at the Bitcoin conference that we attended, and I interviewed him there. And there's a lot of support, it seems like, from the GOP, but hopefully that gets spread out, because to your point, you don't want to have an asset class that people absolutely are going to, or the government is going to pan. With that in mind, let's look at the dollar for a second, because part of the diversification strategy, whether it be into gold or whether it be in Bitcoin, I mean, we got a country down in Latin America, right, that actually chose to hold its sovereign wealth, whatever it had, in actual Bitcoin. And it's been tough, right, because it's hugely, hugely volatile. I would caution everybody with that. But I'm looking at the dollar right now, and it looks like, okay, so it's going down a little bit. Is this right? This is US dollar index, and we're looking at the dollar relative to peers. You know, the ECB, they came out, they jumped the gun. They cut before Powell. I wonder if he felt like he had to do 50 bips because, you know, Europe's hot in the trail.
Yeah, I think he definitely did mention that. You know, it's kind of referring to what other governments are doing to justify the stronger move. But what we see
just
here,
to back
I mean,
up, and the reason you want to have at this point a weaker currency, the reason they're trying to do that is because they want to be able to encourage this commerce sort of overseas, if you would, right? You want American companies being able to sell at competitive prices abroad.
Yes, that's part of it. But you could also see how that now becomes inflationary because,
sure,
I mean, this is why, you know, you raise interest rates and that leads to dollar strength. But then as they get cut, you know, it's dollar weakness. So now we have to pay more for imports because we you know, our purchasing power overseas is lower. And then we'll stimulate exports, and that will kind of, in theory, create jobs. But it's definitely, you know, that's one of the mechanisms through which interest rates affect inflation, and it's doing what it's doing what it's supposed to do. And now we're looking at a weaker dollar relative to other major currencies and relative to gold and relative to Bitcoin,
which should be a little bit sort of a, you know, a helping hand, if you would, to earnings, et cetera. So look, it's very easy to be negative on the government, and certainly I've been extremely critical of the Fed and obviously this administration and their economic policy, which to me is completely, totally, utterly lacking. But that said, you know, I'm okay with, I mean, I love King Dollar, but sometimes, you know, doing what we're doing sort of on the margin, I think probably helps the overall environment for corporate earnings. I mean, the flip side of that is you never want to be devaluing the dollar because guess who pays the price? Americans here at home, which gets you back to, dare I say, why you need to be investing, right? Whether it be, as we've talked about, in gold as a way of, hedging your inflation, whether it be in equities. I think you have to be really selective in a time like this. I'd still be looking to, look at my inflation protection portfolio and the basic income portfolio, and then also this resilience, American resilience, because this is a real story in terms of tech opportunity right now. I think you have to consider that, knowing that the Fed is always going to tinker and that you're always at risk of a bunch of morons in Washington, D.C., not really getting it.
Yeah, when we look back at this whole cycle from COVID to today and the inflation, look, everything that was done ended up, to the benefit of asset owners. Stocks had a rocky ride with the uncertainties around COVID, but you had tremendous buying. We were talking about it earlier.
Huge.
Amazing. Buying opportunity.
I was looking at my portfolio the other day, and I went back and I looked at. I did a lot of buying around that time. It really infuriated me. It sort of came out on air my last night on Fox. Because I was like, you got to be kidding me. You people are like driving the market down 2,000. I mean, this is insane. This is insane that we have ratcheted up the hysteria. Now, looking back, I mean, people did get really hysterical and, the whole country was shutting down, and I get it. And, we don't want to ever relive that. It's quite possible we will. But I think having gone through that, having gone through what we went through in 2008, having gone through what we went through in 2000, I think the moral of the story is don't bet against the USA. And as freaked out as the media gets and as freaked out as Wall Street gets, the answer is, have your own compass and know what the end game is. I mean, if you got to get out of the market in a year, that's maybe a different story. But I looked at that back in 2020 and in March, and I'm like, okay, so, I'm buying. I'm buying when everyone else is selling. And it turned out to be a very smart move in retrospect.
Yeah, it was. And I mean, in those periods of dislocation, you get panic selling and you get kind of these technical factors that just kind of, it's like sort of like, what are the Black Friday on Thanksgiving, like it's like just these flash sales to buy good companies, on deep discount. Um, but yeah, I think, it's don't bet against the USA, but it's also like don't bet against the Fed and don't bet against the way the system promotes growth
Even if we get annoyed with the system, even if we get annoyed with the Fed, it's like, okay, we're realists here because you want to make money.
yeah, it's like don't hate the player, hate the game, right? I mean, we're in this system. There's nothing we can, it's a pretty good system, and you want to thrive within the system. And I think the system is very much geared towards people who put their money into risk assets, and they're rewarded over time.
So with that in mind, I just want to once again shout out, we're going into a weekend, so it's a great time for people to focus on this stuff. I know I focus a lot on the weekends on my personal finance. Rob and I are always talking about opportunities in markets. We're always talking through our portfolios and making sure, we're not here to get you in and out of things. If we add something to the list, it's because we really are big believers long term in what those opportunities are. So this is not like, we're going to run in and out of companies, but it is a good time. I encourage people to spend some time over the weekend here and go to our website. There's a lot of stuff for free. Just sign up for 76 Research. Try to get the 76 report if you can swing it. It's $1 a month. And guess what? You know what? You can cancel for free anytime. So it goes to $9.95 after the first 2 months, but you can cancel anytime. So I like to remind people of that because no harm, no foul, right? Go try it out. And there's a lot of ideas there for you and a lot of explanation and a lot of great reading for you to do. And then, if you are really ready to go, we have 3 different portfolios that have performed very strongly. I was just showing you the basic income builder portfolio. So take a look at those as well. 10 to 15 stocks in each one of those names. You can sign up for the Founders Club and get everything, including the 76 report at the best discount. So that's the best deal. But I believe so passionately in this. I have for years. I've told you, Rob, like over the, all through my career at conferences, or even just, in the makeup room, say, at CNBC or Fox where I've worked, I'd have makeup artists say to me, what do I do? How do I do this? Like, what does this mean? Where do I start? And so hopefully this is a way for people to get started, because I really feel like you need to roll up your sleeves and have some ownership of this yourself.
I agree. And I think, the industry, the financial services industry or the asset management industry isn't necessarily inclined to make it that easy for individuals to kind of do it themselves, right? Because they want to do it for you. They want to collect fees and be
there's
paid
fees everywhere
to wade through the
Not
the
with us,
confusion.
by the way. It's very transparent. That's actually it's one of the cool things that we're doing, because you pay your $9.95 or you pay your portfolio fee, and that's like it. So our only incentive is to provide you the best possible research. We're not incentivized to send you into this or that product, because there's, it's just to have the very best research possible to make you the most money.
Yeah. And the last thing we want is to have lousy research or lousy ideas that don't work, right? I mean, that doesn't help us. That doesn't help us, our subscribers.
The pressure's on.
the pressure, you know what? Still. When you're an investor, the pressure is always on, right? I mean, it's always about looking at, what are the opportunities, what are the risks. It's a competitive game, but it's fun, and we have fun with it.
One of the things I hope we should maybe next week we can talk about this. I'll just allude to this right now, because as you and I were talking this week, you made a very good point. You said something about how people will be in the grocery store and they'll be weighing this can of tuna fish versus this can of tuna fish and saying, okay, well, what is the price per unit? And I have a little savings on this one. And the truth is, that's all fine. But can you take that strategy and actually put it into your portfolio and start looking at what you're doing and what you're in with the same kind of enthusiasm? And I think it's hard for people, because the industry, as we've said, doesn't really set itself up as being user-friendly.
Yeah, it's hard for people. And I think, it's somewhat intimidating it takes a lot of mental energy. It does take some commitment, and you have to read and you have to research and figure. I think my suggestion would be, think about your return on time invested. Your your return on time invested is so much higher if you're thinking about your portfolio and managing your investments and thinking about your tax implications of your investments and getting smart on that stuff, rather than some of the other uses of time that you might have, like that example of being in the supermarket and struggling over trying to save 10 cents on a can of beans. I don't know how many people are really doing that, and usually the people who are investors are the same people who are analyzing the different costs of the can of beans, but just because they're in the mindset.
Yeah.
But you want to get in that mindset, right? You want to get in that mindset of really kind of being thoughtful. And
I was explaining this to one of my kids the other day, because my son is angling for the new iPhone, the iPhone 16. And, he's like, I can turn my iPhone 15 in and get the 650. And we had a discussion about, okay, so what is still the outlying cost? If it's $600, is it really $600? Because guess what? If you put that money in the market instead and you left, you made do with the iPhone 15, tough life you got, kid. Hey, you know what? That over time, that compound interest, that adds up. And so really the cost of that iPhone is not $600. It's many, many multiples of that. It's thousands of dollars. And I think if you start sort of training yourself, and I'm trying to train my kids to think that way, then that ultimately is going to pay off in spades.
Yeah. And
not that we
at
need
some
cheapskates.
point, there's so much psychology and that goes into investing and to building up like kind of the discipline and the thought patterns that you need to kind of do well as an investor. So we'll definitely have to return to that topic, because that's like an infinitely fertile area of discussion.
For sure. And I think something that people are still hungry to hear is our friend Peace of Mind says, compound interest is a real thing. Indeed, this is I'm telling the kids. Why don't they actually teach real home economics? I'd like to know in school these days. I mean, you get some older kids than me. Like, are they actually teaching home economics? Like, okay, credit card, mortgage, the cost of capital, compound interest. I don't think anybody teaches that. And it's weird that they don't.
No, it's like a survival. In the 21st century, it's a survival skill at this point, right? And it's really to the benefit of the entire country that we have a citizenry that can navigate these issues, that understands, don't load up on credit card debt and pay 24% interest rates. That's not going to be a recipe for.
I mean, you think about that, right? Like if you're paying 24% interest rate, I mean, wow, here I am just trying to, tell my son, hey, you don't want to do the cash expenditure because the compound interest value on that $600, you think you're getting a deal on for the phone is actually, it's costing you so much more. And then you think about, people taking on credit card debt, et cetera. And it's so much a part, unfortunately, of our society. And I also think that they're preying sort of in some ways on this naivete. The industry itself preys on the naivete, the financial industry itself, and even the people that are trying to help you and the brokers, et cetera, but then obviously the credit card companies, et cetera. And we're not, as a society, I'm going real big picture here, doing enough to equip kids with a better sort of fact set.
Yeah, I mean, if you want to have a free capitalist system, you need a citizenry that's basically competent and educated and can function, and won't fall into all of the traps and be taken advantage of. And I think there's a lot of doubts, at least on my end, that we're equipping our kids in that way. I mean, some people are, but some people aren't. So
we have a lot of gold bugs here. MJ Smith says MJ's out buying gold every time they're going to Costco. So James pointing out that we need to get the libs out of the schools. Maybe then we can teach some real home economics. Forget about the cookies. I'm sorry. I mean, the cookies are great, but you know what? Let's talk about real economics, and let's talk about home economics as it relates to how we invest and how we plan our futures. It's great to see you guys. It's so wonderful. I mean, this is a very tiny channel that Rob and I have. So many of you have come over from the Trish Regan show, and I so appreciate it. Do us this favor. Make sure you subscribe here on 76 Research as well. Subscribe to the show and hit the bell so that you know when we're here, when we're live. We're going to have a lot of content coming out for you over the weekend. Go to the website, 76research.com, 76research.com. Try to get those model portfolios. I'm telling you, if you can, if you can do it, you really ought to be taking a look. Lots of different opportunities there for you. Thank you so much for tuning in, everyone. Have a wonderful weekend. Rob, always a pleasure to see you. We'll talk some more, and we'll see you guys right back here.